Welcome to The Explainer. Today, we're going to get into the ideas that shape our entire global economy, and we'll be using Michael Woodford's groundbreaking work, Interest and Prices, as our guide. So let's start with a question you've probably had watching the news. I mean, it seems like such a tiny number, right? 0.25%. But it can send markets spinning and affect everything from your mortgage to your savings account. So what is the big deal? Well, to really get it, we actually have to go back in time. For a long, long time, money was actually tied to something real, something tangible, gold. But then, well, that all changed. So picture this. In the early 1970s, the world just ditches the gold standard. All of a sudden, central banks were basically flying blind. They had all this new freedom, but absolutely no rule book to follow. And the result? It was a decade of economic chaos, with runaway inflation that created a ton of uncertainty for pretty much everyone. You know, more than 100 years ago, economists like Knut Wicksell were dreaming about perfectly stable prices. But back in the 70s, that idea felt like a distant fantasy. The world desperately needed a new map. Okay, so the old system is toast. What now? Well, economists went back to the drawing board, and they came up with a whole new framework, a new rule book, that was all built on a really simple but incredibly powerful observation about how prices work in the real world. And the key idea they landed on is something called sticky prices. It's not like in the old textbooks where prices just magically adjust every second. In reality, a coffee shop can't change the price on its menu board every single day. Prices are sticky. They take time to adjust. It's a simple idea, but it changes everything. And this was a huge shift in thinking. You see, the old models, they basically said the real economy, jobs and production, and the money economy were two separate things. But this new synthesis, because it understood prices were sticky, it showed how they're completely tangled up. And that meant central banks weren't just sitting on the sidelines. They could actually steer the economy. This new way of thinking also brought back an old idea from Wicksell, the natural rate of interest. Just think of it like the economy's neutral gear. It's that Goldilocks setting, not too hot, not too cold, that a central bank is always trying to find to keep things running smoothly. Okay, so now that we've got this new rulebook, how does a central bank actually steer the ship? What's its most powerful tool? You might think it's just about changing interest rates right now, but it's actually something a lot more subtle. It all comes down to this, shaping what everyone expects to happen next. It's not really about today's interest rate. It's about what you, me, and everyone in the market believes the rate will be tomorrow, next month, and even next year. So don't think of a central banker as some engineer pulling levers. A better way to see it is as a ship's captain, standing at the helm and clearly telling everyone on board where they're going. If people trust the captain and the plan, the whole journey is way smoother. The market often starts to do the bank's work for it before they even have to make a big move. Now, this leads to a pretty interesting kind of counterintuitive idea. I mean, shouldn't we just hire smart people and let them make the best call in the moment, give them the freedom, the discretion to react? Well, the theory actually says no. The big problem with just making it up as you go is that it can totally backfire. A little surprise boost to the economy might feel great today, but it teaches people not to trust what you say. It erodes your credibility. And that leads to higher inflation down the road, which makes everyone worse off. And this is really the takeaway here, credibility is everything. Sticking to a predictable rule, even if it isn't perfect for every single situation, ends up giving you much more stability in the long run. All right, so let's circle all the way back to where we started, that tiny little number. Why on earth do we care so much about 0.25% change? Because it's not just a number, it's a signal. It's the central bank's way of saying, hey, we're sticking to the plan, you can count on us. It's all about reinforcing that credibility and managing our expectations for what's coming next. And really, this whole new way of thinking is what runs modern central banking. It's why they talk about inflation targeting. It's where things like the famous Taylor rule come from, that formula that helps guide interest rate moves. The bottom line? It's all about managing the future by being really, really predictable today. Now, this whole system, which has given us decades of pretty stable economies, it really hangs by a single thread: trust. Our belief that the central bank will actually stick to its rules. So the question to leave you with is, what happens when that trust starts to break down?